All right, let's get right into it. Today, we're tackling a massive question that seems to have every investor scratching their head. We're going to dive deep into the hidden plumbing of the financial system to understand a force that could totally reshape the markets come 2026.
This is the big paradox, right? You look at the news, and it's all about stubborn inflation, unpredictable central banks, and global tensions heating up. And yet, stocks, crypto, all sorts of risk assets just keep climbing. It really feels like the market is playing a completely different game. So what on earth is going on under the hood?
Okay, so let's jump right in and try to unpack this paradox. We're going to break down why the classic economic rulebooks you and I learned about might not be giving us the full picture anymore. Look, ever since the 2008 financial crisis, something fundamental has changed in the system. The traditional tools, central banks tweaking interest rates, they just don't have the same bite they used to. The old, predictable relationship between government policy and market behavior has gotten, messy. The models we've relied on for decades just can't explain what we're seeing. The real answer isn't in the headlines. It's buried deep inside the plumbing of the system.
And that's our first big clue. It leads us straight to the U.S. debt machine. Believe it or not, the sheer scale and the mechanics of how the U.S. government funds itself is probably the #1 engine driving this bizarre market action. The numbers here are just mind-boggling. By 2026, the U.S. government needs to refinance, or basically roll over, about $6.2 trillion in short-term debt. But here's the real kicker. It's not just the amount of money that matters, it's the frequency, how often they have to do it, that has quietly changed the entire game.
Okay, stick with me here, because this slide is where it gets really interesting. It shows how a tiny technical change creates this enormous ripple effect. So, in the old days, the average lifespan of these Treasury bills was about 180 days. That meant the $6.2 trillion was rolled over about twice a year, moving around $12.4 trillion through the system. But now, check this out. That average lifespan is shrunk to just 140 days. It doesn't sound like much, but that shorter fuse forces about 2.6 rotations a year. That little tweak, it pushes the total amount of cash sloshing around to a massive $16 trillion. So let's just let that sink in for a second. That small change in how debt is managed forces an extra $3.5 trillion of liquidity to churn through the financial system in 1 year. And this isn't some stimulus package being debated in Congress. This is a structural requirement. It's happening automatically, like clockwork, in the background.
And if you're still trying to wrap your head around that number, this chart puts it all into perspective. Think back to all the headlines about quantitative easing, or QE, right? That historic program injected about $1.75 trillion over 2 years. The structural liquidity we're talking about in 2026 is double that amount, and it's happening in just half the time. It is a colossal, unavoidable way of money.
All right, but that's not the whole story. The debt machine is just one piece of the puzzle. There's another floodgate that's about to open, and this one is all about the banks.
Now, this sounds super technical, I know, but trust me, it's a huge deal. A rule that's basically a safety buffer for banks got a little bit relaxed. You can think of it as a rule telling banks how much cash they have to keep locked in the vault just in case. By easing up on this rule, regulators are essentially giving banks a green light to put more of that locked-up cash to work.
So what's the immediate result? Well, the entire banking system suddenly has about $275 billion of extra capital just freed up. This isn't freshly printed money, by the way. This is capital that was already there, but it was tied up by the rules. Now, it's ready to be used.
And this is where things get wild. Because of something called the banking credit multiplier, that $275 billion isn't just $275 billion. It's the foundation. Each one of those dollars can be used to support several more dollars in loans. This could potentially unleash trillions more in new credit and investments, basically pouring gasoline on an already roaring fire.
Okay, so we've got the U.S. debt machine and newly empowered banks. But this isn't just an American story. This is a global phenomenon. And guess who's about to join the party?
China.
So, China's economy has been hitting some bumps in the road. And what do central banks do when that happens? They usually step in. The widespread expectation is that they're going to inject a ton of liquidity to get things moving again. And in today's interconnected world, that money doesn't just stay put. It's going to spill out into global markets, looking for a place to go, adding to this worldwide pool of capital.
So let's step back and look at the big picture. You've got the U.S. debt machine churning out trillions. You've got U.S. banks with new freedom to lend.
and you have China about to open up its own fire hose of cash. When you put it all together, well, it's not a wave, it's a tsunami.
So how does this actually play out? Let's follow the money. It all kicks off with the Treasury's refinancing, which pushes all this cash into banks and big money funds. Suddenly, they're flush with capital. Then, the banks, with their new relaxed rules, ramp up their lending. And finally, where does a lot of that money end up? Yep, right back in the market, being used for things like stock buybacks and buying up other assets. It's this cascade that just keeps bidding prices higher and higher.
And this really brings us to the main point of all of this. When you have these massive structural forces just cramming this much cash into the system, it gets really, really hard to be a bear. The typical arguments based on bad economic news start to lose their punch against the sheer volume of money that has to find a home.
Now, to be perfectly clear, this isn't about saying risks don't exist anymore. Of course they do. A major unexpected event could always change the picture. But what we're talking about here is a structural tide of liquidity so powerful it could simply wash over all those traditional worries. So maybe the market isn't being irrational. Maybe it's just responding logically to this overwhelming flood of money.
And that leaves us with a really fascinating question to chew on. When the entire system is structurally designed to be awash with cash, what does risk even look like anymore? This is the new reality we might have to navigate, where maybe the biggest risk isn't an economic downturn, but trying to swim against this powerful current. Definitely something to think about.